Hey there, everyone. Happy Wednesday, February 11th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny and clear February day here in Redmond, Washington. Hope you guys are all doing well, wherever you're at. And thanks so much for tuning into the show today. We recap market conditions every weekday after the close. And our show has three parts. If you've not tuned in before, we'll do a quick market recap where we'll focus on some of the key movements in major asset classes, with the focus, as always, on equities and ETFs. We'll then get to the heat map, the market carpet on stock charts, where we'll dig down into some of the stock and sector and group themes that have played out today. And we'll finish off with some charts that I've hand-selected to review with you, highlighting some of the conditions that we observed today. The short answer is the S&P 500 was an unch. It was a nothing burger, as we say in the technical analysis community. It was a flat day. It was a choppy day with a higher open and a sell-off in the first hour of trading, but then it settled into a flat day. And by the end of the day, the S&P was literally 0.00% away from Tuesday's close. So not a big move. And that's interesting because after the economic data that came out this morning, big higher open felt like this could be a big move to the upside. But that higher open was sold off immediately. And again, the rest of the day was relatively flat. As always, we so appreciate your questions. Thank you, those of you that have watched the show and have dropped questions in the comments section on our YouTube channel. We're planning an all mailbag episode on Friday of this week, and we'd love to answer one of your questions on the show. So please drop a question in the comments section. While you're there, like the video, share it with your friends. All of that helps, and I appreciate you guys watching, and hope you find the work helpful. Let's talk about the major averages today. The S&P 500, as I mentioned, flat. So we finished today right around 69.41. The Dow still holding the 50,000 level, but not by much. That was down slightly. The Dow and the NASDAQ down less than 0.25%. So this was not a big movement day. Mid caps, small caps, all down slightly. The VIX down slightly. This was a quiet day. It's interesting. After we've come through earnings, which was a fire hose of news, there are stocks that are just ripping to the upside. There are stocks that are heavily trending lower, but all of that is netting out to the S&P being dead even. And that's the story in today's session. Arguably, that's been the story since Thanksgiving of last year, maybe even October, right? I mean, we hit the new all-time high around October. That was the first time that 7,000 seemed like a real possibility. And from there, we've really been sideways. What's very interesting, though, we don't talk a lot about international markets here on the Daily Market Recap Show. However, one of the charts that I selected shows you the performance in EFA, which is Global Developed Markets, versus EM, Global Emerging Markets, versus the U.S. One of those is not going up. It's more sideways. The other two are trending higher. And I will let you figure out which one of those is not going up, and it's the S&P, basically flat for the last 3 months. Looking at the bond markets, you can see that TLT was down by about 0.5%. That's an ETF that tracks Treasury bond prices, sort of the longer end of the curve. The 10-year yield drifted higher today, around 4.17. The long bond yield's back about 4.8%, and the 5-year point right around 3.75. The dollar was basically flat for the day. The UUP essentially unchanged after a bit of a choppy session. Looking at the commodity space, I mean, we are still, I would say, even though it's been a volatile stretch here in 2026, days like today, weeks like this week, I think remind me that even with all the noise, gold and silver remained in primary uptrends. Even with all the noise, crude oil now a pretty compelling chart as it's breaking out of a pennant pattern. We highlighted that on the show yesterday. Today, kind of pushing out of that pattern to the upside, I would argue. Gold and silver both up. Silver up 4.3%, and that's the best performer out of the commodity ETFs that you see here. So we're back in a situation where stocks are flat and commodities outperforming here. Cryptocurrencies continuing to struggle. Bitcoin is currently trading just below 68,000. It was up around 70,000 or so yesterday. By the time we were doing the show, it was back down around 69,000. Now we're giving back a little more. It's down all the way to 66,000 earlier in the day. Eastern time rallied through the course of the equity session, but still down about 1.7% from yesterday. Ether prices down about 3%. We're back below 2,000. You can see all 10 of the top coins tracked on the stock charts platform, all in the red today. All right, looking at the 11 S&P sectors, decent day in terms of sector breadth. 7 out of the 11 sectors were higher. Energy leading the way to the upside, 2.6%. That's what the XLE was up today. That is by far the top performing sector. That strength in crude oil prices really starting to be reflected with optimism across the energy landscape, from E&P stocks to infrastructure stocks to the big integrated names. Generally doing pretty well here. Earnings were fairly positive. I know from the Super Bowl themed stock picking exercise I did over the weekend with Tom Boley and Grayson Rose, energy ended up being the sector with, I think, the most stocks selected. A number of people were looking at that sector for good reason. The charts have been pretty good, and the charts have not been good for so long that it's pretty refreshing to see that improvement. Number 2, though, consumer staples, one of the more defensive sectors. Consumer discretionary is third from the bottom, down 0.5%. So that ratio of offense to defense continuing to favor defensive sectors. We'll show you that ratio chart, making a new 3-month low today. So if you're looking for reasons to be not so bullish, I would say the outperformance of defensive sectors top of mind for me. So at the top, we had energy, consumer staples, materials up 1.33% to finish off the top 3. On the bottom, financials down 1.5%. We're seeing a number of financial stocks kind of struggling. I think yesterday on the show, we dug into that a little bit. Communication services down as well, 0.7%. Consumer discretionary, as I mentioned, down 0.5%. The 2 big ones there, Amazon and Tesla, struggling a bit here recently, and that's really weighing on the XLY. Breadth was neutral-ish, but it depends on where you look, right? So on the S&P 500, 57% advancers to 43% decliners. That was the best breadth in any of these major U.S. indexes. The top line shows you the New York Composite Index, which I like to use for breadth because it's a pretty diverse group of stocks. You've got some growth, you've got some value, you've got some large cap, some small cap, kind of everything in between. So I like that as an equal weighted measure of market participation. 52% of the NYSE names were up today versus 46% to the downside. The breadth in the NASDAQ was the worst. We're continuing to see growth underwhelm here in February of 2026, about a 2-to-1 ratio of stocks declining versus advancing on the NASDAQ. Looking at the Magnificent Seven and friends, NVIDIA, Tesla, Broadcom, Apple, all up more than 0.5%, less than 1%. So that's encouraging. The real pain, though, is in the bottom. Netflix down another 3.2%. This has been, I would say, without argument, the worst chart of this basket in a consistent downtrend phase here for a couple months. Alphabet, which has been arguably the best chart, I would say, Alphabet, it certainly has been in the most consistent uptrend for the longest period of time, down 2.4%. That chart's starting to look quite vulnerable. And that's part of that big rotation away from growth leadership names in January into February. Microsoft getting a 2.2% haircut, again, struggling to find its footing, struggling to hold support after earnings. All right, well, we'll get to the heat map in a moment, but I did want to start with a bit of a quiz here. I have the Magnificent Seven and Friends. So the Magnificent Seven and Friends is a basket of stocks I like to track. These are your mega cap growth stocks. It's kind of the Mag 7 names, but I'm including like Broadcom and Netflix in that bucket of stocks to represent kind of the key growth leadership names. I'm sorting this table at the moment in year-to-date performance. So note that only 3 of these stocks are up year-to-date: NVIDIA, Apple, and Meta. All the rest of these names are actually down on the year, and Microsoft, the worst performer, down over 16% so far in the first, 5-6 weeks of 2026. So here's the quiz question. Out of these 8 stocks, how many of them are above both their 50 and 200-day moving averages as of today's close? How many of these stocks are above both its 50 and 200-day moving average today? Do you know which one it is? And there's your hint. It's only one of them. That, more than anything, I think is an issue, right? When you think about the change from a Magnificent Seven dominated market to whatever we want to call 2026, but more of a value-oriented market, the fact that only one of the names that I'm showing you here is above both key moving averages, I think is very, very telling. The correct answer is it's only Apple. Apple, after rallying from earnings last week, getting back above its 50-day moving average. That's the only one that's currently sitting above both the 50 and the 200-day. And the bad news is today is what we would call a hammer candle. Sorry, that's not true. Forget I just said that. That's called a shooting star candle, which is in an uptrend. You have the open and close near the lows of the day, big upward stem or wick, very small lower stem. That's a shooting star candle, implying short-term weakness. So that's not good. Next 1 to 3 bars more likely lower than higher, and use like 280, 282. The peak of those hammer shooting star candles. Come on, Dave. The shooting star candles there. That if we get above there, that would negate the bearish candle structure. But for now, kind of negative. If you guessed Alphabet, if you guessed 2 of them, Alphabet. Bad news is with the sell-off that we've had this week, it's actually below its 50-day moving average. And I think that's important. I think it's important that names like Alphabet are not holding their 50-day. And the problem I have with charts of Alphabet is we've seen warning signs. We've seen divergences with higher highs January into February on weaker momentum. Now we're seeing the price fail to hold the 21-day EMA, now fail to hold the 50-day. And we're seeing the RSI push below 40. That's the first time it's done that since the April market low last year. So this is a chart that's been in a consistent uptrend. This has been the poster child for strength in growth. This has been the last stock standing, I feel like, as names like Netflix and Meta and Microsoft and Amazon and Tesla have all struggled, have all broken support. Alphabet's been like that one name continuing to go higher, just nurturing optimism for AI and cloud computing, and how growth stocks can still go up with no pause. Now even Alphabet's feeling the pain, down another 2.4% today. So I think that's an issue, that Alphabet is below its 50-day moving average. So the correct answer is only one stock. It's Apple. Everything else on that list below both the 50 and 200-day moving averages. Friendly reminder, appreciate your questions. We're going to do an all mailbag episode on Friday, and we'd love to answer one of your questions on the show. So please take a moment on our YouTube channel, drop a comment with your question. While you're on our YouTube channel, by the way, we had a video last week laying out 4 different scenarios for the S&P and asking you to review these scenarios and then vote on which one you think is the most likely outcome and why. It's not too late to check out that video and vote. And now you have the benefit of reading all the comments and the votes that other people have left. Can be really helpful, particularly if you're bullish right now. Read some of the comments where the people voted for the bearish scenarios. See what, listen to what they're saying. Maybe it's something, maybe it's a blind spot. Maybe it's something you haven't, really, considered. If you're really bearish right now, read some of the bullish comments. Read what evidence people are looking at to feel that the market conditions are going to be pretty positive here in the weeks to come. Challenging your investment thesis is what a mature investor, I would argue, what a mindful investor, what an intellectually honest investor does. An intellectually dishonest, a mindful investor picks their thesis and ignores everything else and treats it as noise and just kind of digs in their heels on what they think because they know it's right. Mindful investors know that they are often not right. They know that there's value in considering an alternative hypothesis, in stretching your thinking outside the box. I hope what we do on the show helps to nudge you out of your thinking. And that series of videos, what I call the choose your own adventure style videos, I hope will help you along that process of opening your mind to other perspectives and outcomes. So please check it out. All right, heat map. I mean, not great, but it depends on where you're looking. So a couple observations having dug through the heat map. First off, I'm going to go right to left today. We're going to start in the upper right corner with the fact that one of the most defensive sectors, consumer staples, remains pretty strong. And it's charts like Walmart, which have been in primary uptrends. It's charts like Coca-Cola, which have been spiking higher. It's charts like ConAgra brands, CAG, making new 3-month highs again this week. It's beverage companies like Molson Coors, ticker TAP, making another 3-month high today. It's an interesting sector. It's a mix of stocks, and there are some stocks that aren't great in there. Don't get me wrong. It's not like everything's good in consumer staples. There's some dogs in there. However, there are a lot of nice, consistent uptrends like Coke and Walmart. There's a lot of really interesting emerging areas of strength like CAG and TAP. If you've been ignoring consumer staples, I don't blame you. It's not been a great sector, but we're seeing big changes as Palantir and Alphabet are breaking down below their 50-day. These are the names that are actually breaking above moving averages. That's happening. It's just not in the growth sector. So shout out number one to consumer staples with that strength. Number two, I'm noticing just these strong uptrends in the industrial sector. Caterpillar and Howmet Aerospace, two names that were selected as part of that stock draft over the weekend. I picked HWM. I'm pretty sure Tom Boley picked Caterpillar, but just making another new high today. John Deere making another new high today. UPS making a new all-time high today. Train Technologies kind of right at a new 52-week closing high. So there's a lot of strength in the industrial sector as well. The energy sector, right? This has been an area that, again, had been underperforming for so long. But look at pipeline stocks like WMB making new 52-week highs. Look at big integrated names like ConocoPhillips, COP, making new highs. Look at DVN, Devon Energy, making a new 52-week high today. So there's strength in pipelines. There's strength in a number of different groups in the energy sector. And again, if you avoid energy when the charts are all pretty bad, I don't blame you, right? I don't blame you when there's a sector like the XLE that's been underperforming. You can't say that anymore, right? The energy stocks are doing pretty well. Crude oil prices are starting to break out, and the stocks are reflecting that. So ignoring it now, that's a you problem. That's a process problem if we're missing good emerging strength. So I think investors get into trouble when they're still sticking with things that used to work like an Alphabet, and they're ignoring things that are really starting to work in like consumer staples and energy. That's where investors struggle to have good, consistent returns. It's not that you don't find a good idea at one point. It's recognizing that a good idea isn't a good idea forever, in perpetuity, right? It's a good idea temporarily. We're renting these stocks until a better opportunity comes along. And I think this is one of those times where rotating into some of those better opportunities could be a really good idea. Now, while some of those sectors, particularly staples and energy, pretty consistently strong, we have other sectors that are actually quite mixed, like industrials, for example, pretty mixed today, right? We've got a bunch of things up, a bunch of things down. Consumer discretionary, very mixed right now, with some stocks working and other ones not so much. The technology sector, very diverse, right? And you've got some of the semiconductor names like Micron up 10% today. But then within the same, same sector, you've got charts like Adobe making new 52-week lows today. So quite a bit of movement. AppLovin is one that comes to mind because of earnings. We're going to focus on that one. On Semiconductor is another one, which I actually don't see, and I don't know how I'm missing it. Here it is. On Semiconductor making a new 52-week high today. This is after earnings yesterday after the close, if I remember right. Up another 5.6%. So within technology, and again, this is a thesis we shared in our 2026 market outlook. We talked about, and this was in early January, we shared with our premium members, look, 2025 was about owning growth. 2026 is going to be about being much more choosy, not just owning tech, but owning the right tech that's strong, showing, rotating out of things that aren't working, rotating into things that are working. And I think we're seeing that for sure in the technology sector. There are a lot of days, I feel like recently, where this is more what it looks like. Some great, some really bad, and some neutral. In terms of what's consistently bad, I will point to two sectors. Number one, the financial sector. Again, these banks had been in really good charts for the longest time. And it pains me to point out the fact that Citigroup is making a monster bearish momentum divergence going into this week, right? Going into last weekend, we were reflecting on the fact that, look, we're making higher highs, but on much weaker momentum. This week, Monday, then Tuesday, Wednesday, now rotating lower. Today, we closed right at the 21-day EMA, but now we can confirm a higher high around 125 on much weaker momentum. So very toppy behavior in terms of the price momentum relationship. And that's not just a Citigroup thing. There are a lot of financial stocks with a very similar kind of concerning setup with higher prices on weaker momentum. I'm not excited about the patterns that I'm seeing in the financial sector. Regional banks have been an area that I think have been are remain promising. That's based on the shape of the yield curve, but we're not seeing that today here. We're seeing anything bank related kind of going down. The stuff that's green are all insurance companies for the most part, right? AIG, Allstate, Met, Pru, PGR. Chubb. I mean, it's all the insurance names that are actually up today. GL, Globe Life. In the communication services sector, it's about the old school telecoms, AT&T, Verizon, T-Mobile. Look at the chart at T-Mobile, right? I'm not a bottom fishing guy. This is not the main way that I invest. This is an earnings stock today, finished up just over 5%. It's hard to think of this as anything but pretty constructive given what we saw today, right? Lower open, higher close, right? So that's not really a candle pattern to speak. I mean, you might call this a bullish engulfing pattern, but it really isn't. You can't call that because yesterday was an up close. So it's just kind of a non-pattern, but it's definitely a big up day. And the fact that we opened pretty weak and then closed a lot higher, I mean, literally shows you that there's accumulation during the trading day. The momentum, the RSI finally getting above 60, which implies that there's some accumulation. February has been a good start to good month here so far. And I think holding that 50-day moving average is pretty crucial. It looks like today with a weaker open, but closing back above the 50-day, I would see that as pretty encouraging. I mean, look at the 200-day moving average as a potential upside target. Chart like this, by the way, a chart like T-Mobile, I don't use Fibonacci retracements all the time. It's more opportunistic. It's more like when the chart suggests it's a good thing to look at, that's when I kind of look at. Not all charts make sense in terms of looking at Fibonacci retracements. This one is quite helpful here, I would say, because if you look at the downtrend from August to January, here's 38.2%. That's almost exactly. I mean, it's pretty close to today's high. So I think getting above 211, clearing that level would be pretty bullish. Clearing the 200-day and following through above that, key what we call a barometer, a trend barometer, I think would be pretty meaningful as well. All right, those are some thoughts looking at the heat map. And again, pretty mixed day here. The breadth, not so great. The benchmark sideways, but a lot of movement when you go down to the sector and group and individual stock level. This is one of those times where different sectors have a different configuration. More important than ever, focus on good charts. If charts are not good anymore, there are good charts out there somewhere. So remember, if you own a chart that's not good, you are choosing not to own a chart that looks a lot better. Think of it that way, right? A lot of people think, well, it's not that big of a deal to hold something that's going down a little bit. It doesn't hurt that bad, right? It's not hurting my returns too bad. Yeah, that's fine. But remember, choosing to tie up your capital with a weak chart means you are not able to allocate that capital to a much better chart. I'm not struggling to find encouraging and actionable charts right now. So let's not tie up our capital with charts that are not good. All right, we're going to come back here to the show here in a moment. Just want to remind you, thanks to our friends at Seeking Alpha being a great longtime partner to Market Misbehavior. They're doing their February sale here this week, I think through the 15th. You can go to marketmisbehavior.com/Seeking Alpha for information on their premium memberships. This is where you get access to their institutional quality quant model, all of their research and stuff that they have bundled into the premium membership. Also some really good portfolio level analytics to look at dividend payouts for the entire portfolio over a quarter, giving you a sense of when to expect future cash flows. Also the opportunity to look at a health check, which is basically taking your portfolio to a wellness check at the doctor, just helping you identify some areas to focus on. Really good analytics and a platform that I've enjoyed checking out. I would encourage you to do the same. Go to marketmisbehavior.com/Seeking Alpha for more info on their premium memberships. They also have a bundle combining their premium memberships with the Alpha Picks. You can find information there at marketmisbehavior.com/SA bundle for Seeking Alpha bundle. Thanks again, Seeking Alpha, for being a great partner to Market Misbehavior. All right, let's finish off looking at some charts, shall we? The S&P 500, with today's kind of sloppy, sideways, choppy session, did not get above 7,000 yet again. However, we also did not break down. We remain in that green shaded area, which I would say is the green light area. Anything above 6,900 I see is fine. Anything between 6,900 and 6,550 is okay. Anything below 6,550, I think that's a dangerous situation. If you look, when we set this up, which was back here, the 200-day moving average was way further down. So it was like, all right, breaking below 6,550 would be bad, but breaking below the 200-day would be really bad, but that would be another couple hundred points. What's happened is, as the S&P has remained relatively strong, the 200-day has actually been trending higher as well. So now they're actually very, very close to one another. So it's becoming more and more clear to me that biggest risk from a technical perspective is a drop down to 6,550 and then that doesn't hold. I think that will be a key decision point for this market, is whether buyers come in and buy a very, it's been a long time since we've tested the 200-day. That's going to be a crucial test. And if that doesn't hold, I think this market can get very ugly very quickly. However, I mean, you'd anticipate some serious support since we've been shopping around here. Any sort of drawdown, we dropped 400 points here. Can't imagine you wouldn't have at least some sort of meaningful bounce off of that. The question would be whether it's sustained or not. So right now we remain in the green shaded area. We're in a green light area, which means I'm comfortable finding ideas and looking for opportunities. And again, I'm not struggling to find opportunities right about now. I just want to share with you, I don't talk a lot about the market trend model here on the show. This is something that I share with my market misbehavior premium members every weekend. We look at this chart to talk about the market trend on different time frames, what that means for me in terms of my outlook and my positioning and taking on risk. But I've spent a lot of time just reflecting on how this model performs in different market phases and what that might mean. I'm noticing the fact that the short-term model is very, very low. I mean, really, really close to zero for like the last month, right? From the second week in January all the way through today, the short-term model has been dead even. And I think for me, that speaks to the fact that the short-term trend in the market is truly not bullish or bearish. It's sideways. That's what this means. And I don't have any official reading of, if the short-term model is within X percent of zero, it's neutral. I just go binary. I go, it's either bullish or bearish for simplicity. But if I did have a neutral ranking, the short-term model would have been neutral for the last 4 weeks and would remain neutral to this day. With the RSI ranging between 40 and 60 on the daily chart, with the short-term model right around zero, it is literally the definition of a sideways trend. Now, sideways trends always resolve one way or the other, right? It's not going to go sideways forever. So I think that direction of that next move is going to be vital for the S&P. However, let's keep in mind, as the S&P is flat, other areas of the global equity space are decisively not sideways. They're actually remaining in a strong primary uptrend. And I'm looking at you, global stocks outside the US. This chart in the top panel is a ratio of the US, the S&P 500 versus ACWI, which is All Country World Index. This is a global index. It includes US, global developed markets, global emerging markets, all in one index. The SPY has been underperforming the All Country World Index since the end of November, all through December, all through January, and now accelerating all through February. The US has been underperforming global markets. That's, I would say, the reasoning for that is probably a couple things. I would tell you maybe 3 things that would come to mind. My mind does not work very well. I have short-term memory loss issues. So saying 3 things, whether I actually remember those here is going to be a real test. Let's see if I can do it. So how to make sense of non-US markets, doing well. Number one, the weaker dollar. We can see that in the bottom panel with the fact that the downtrend is here, right? So, the fact that the dollar has been weakening, while not the only reason why the US would be underperforming, the weaker dollar usually coincides with weaker performance in this ratio. And you can see that through the general trend of the last year and a half, right? When the dollar's been strengthening, the US has generally been outperforming. When the dollar's been weakening, the US has been underperforming global stocks. Not always, like June of last year, weaker dollar, US outperforming. So it's not perfect, but generally, if you take a step back, you can see these lines tend to trend similar to one another. And that makes sense because a weaker dollar, implies less strength in the US essentially. So weaker dollar is part of that. Second thing I would say, you could argue lack of confidence in the US markets, right? We're not with the weaker dollar. That implies that a lot of non-US investors aren't converting to US dollars to buy US assets. This implies more of a flight to somewhere else, a flight to quality, a flight to safety. I don't know what you want to call it, a flight outside the US. But, if everyone was getting nervous and rotating into US Treasury bonds, you would expect the dollar to be strengthening, implying, more demand for dollars. We're not seeing that. We're seeing weaker dollar action. So could imply a lack of confidence in the US markets for whatever reason. I would argue instability and uncertainty is probably a big part of that. The third one would be just the the market structure, right? So in the U.S., we have a very growth-oriented set of benchmarks. So the S&P, which is the numerator there in that top panel, is very growthy. So when growth is outperforming value, and when we have an AI-dominated market theme, and when the Magnificent Seven are running everything and outperforming everything, the U.S. is generally going to outperform in that condition, generally, because our benchmarks just have a bigger exposure to growth, right? Non-U.S. benchmarks don't have 35% weight in technology, which is what we have in the U.S. We have a very growthy benchmark. Look at Canada. Technology is nowhere near anywhere near that sort of dominance. That's very much a U.S. specific thing. There are some other random markets with a bigger technology component for sure, but the U.S. is one of the larger markets, very, very unique that way. Other markets, like in Canada, more about basic materials, maybe financials, like a lot of emerging markets. It's a lot of the banks that are the biggest weights, or energy commodity kind of companies. But in the U.S., it's services, right? So it's technology and consumer kind of names. So the fact that growth is underperforming in 2026 is definitely not going to help the U.S. outperform. It was tough to think about investing in Canada as a U.S.-based investor when growth was outperforming value, because that's just not a scenario where Canada is probably going to outperform. That's changing now. Crude oil prices are going up. Energy is working. Materials are working. Canada is going to be outperforming most likely in that scenario. Another way to think about it, this in the bottom is the S&P 500, and I have the 50-day moving average. We're looking at the last 2 years to show the general trends here. And all of these, from the top, we have EFA, which is global developed markets, developed Europe, developed Asia. This one is emerging markets, so China, India, developing Asia, South America, all developing Europe, all together. And then the bottom, we have the U.S. represented by the S&P 500. Look at how all of these indexes trending higher off of the April 2025 market low, fairly consistent uptrend all around there and moving in a very similar way. Look at how all of them broke their 50-day moving average in November of last year. All of them kind of recovered and started to go higher. But once you hit 2026, EFA, global developed markets, strong uptrend continues. EEM, which is global emerging markets, strong uptrend continues. The U.S., flat, right? The price is right at the 50-day moving average, which is still trending slightly higher. But if you look at the price action, it's really more sideways, highs and lows kind of even. Compare that to a continued uptrend. So EFA and EM both made new all-time highs today. The S&P not making new all-time highs. So there's a divergence here because of those reasons that I mentioned. Still very much a situation here. In my own portfolios, I'm way more tilted to non-U.S. markets because of charts like that. Momentum models that I run have just been favoring non-U.S. markets since the fourth quarter. So I follow the model with some of my accounts. All right, offense over defense, as I implied, getting weaker here. We can see year to date, consumer staples have been outperforming consumer discretionary. And that's on a cap-weighted basis, like the top panel, and an equal-weighted basis in the bottom panel. So this isn't just about Amazon and Tesla and Home Depot struggling. This is a general trend of consumer staples, things you need, over consumer discretionary, things you want. Looked really interesting here in early January as the equal-weighted version was making a new all-time high, but that was it. And from that moment on, these ratios have been going down. Out of all the things I'm going to show you today, the reason why I would be least excited about the state of the U.S. equity markets, this chart right here, because that ratio going down is usually not a good sign. Shout out to my friend George Noble. George is a fascinating human being and an awesome market practitioner, someone who I've enjoyed getting to know over the years. George had a great post on socials, particularly on X, and I'm going to share this with you. You should follow George. I mean, he is a quirky genius about investing. He's had so many great experiences. He talked about, welcome to the AI bull. He talked about the .com Super Bowls and just, looking at which companies appear to be like borrowing aggressively or spending obscene amounts of money, even, especially when their businesses are not really created yet, right? They use this as an opportunity to get something going. It's like a full-on roll the dice moment and use a Super Bowl ad to generate a ton of interest in a product that's not ready yet. We saw that with the .com Super Bowl. And again, the .com bubble was clearly a bubble that popped very soon after. 2022 was the crypto bull, where every ad, it seemed like, was every other ad at least, was about cryptocurrencies and crypto exchanges. And we saw what happened in the year after that. Arguably, this is the AI bull with OpenAI, with Alphabet, Amazon, Meta, Anthropic, Base 44. I mean, some of these aren't really products yet, right? You go to the one, I forget what it was, AI.com or whatever it was, that had you go and reserve your domain. And it's not actually a working product. It's literally just trying to get people to go and reserve their domain with an expectation that it might be something you might want to have at some point. It's of all the bubble-ish kind of things that I've seen, I have to agree with George's take on the AI firms that I saw in some of the ads that I observed. Very, very frothy and reminiscent of the crypto experience in 2022. Very reminiscent of the .com, like pets.com kind of Super Bowls, which felt pretty frothy. Similar amount of froth here. And again, charts like Palantir showing more weakness than strength. Here's the chart of Palantir just to show the the weekly trend in Palantir with strength 23, 24 into really the fourth quarter of 2025, and that's been it. From there, it's really started to rotate down, and just in the last month, broken down through the 50-day, broken down through the 200-day moving average, and now continuing to deteriorate. Weekly chart not looking great here. It's not all technology companies that are bad. We saw that with the heat map today, with some of the charts looking actually quite good. And you can see that on the chart, excuse me, on semiconductor after earnings yesterday, or maybe Tuesday that was, higher day yesterday, another 5.6 to the upside. So I wouldn't write off a sector like technology because of potential frothiness. I would keep looking for good charts, right? If a chart deserves a place in your portfolio based on the trend, it deserves a place. That's a stock that's outperforming so far in 2026. Biotech, the other tech, right? The biotechnology space, Gilead reported earnings yesterday, up another 5.8%. That's after pulling back going into the earnings release today, opening a bit higher and then pushing to the upside, new 52-week high today. On the other side, Robinhood, we highlighted reporting earnings yesterday. Today, gapping lower, a bit of a doji candle with the open and close right around the same level. But this is similar to Palantir, something that's just completely rotated lower, now below the 200-day moving average. Something like that, I'm thrilled if and when it gets back above the 200-day. Until then, I'm happily avoiding it. AppLovin reporting earnings after the close here. Let's take a look and see what's happening. Down to 432 in the after hours. That means it's kind of down around here. That's not too much below today's low, kind of right around that level. So not a huge development yet. A bit of a weird pattern. It's almost looked like it was going to be what's called an evening star candle. That's where you have a pattern where you have a big up day, you have a little star, like a separate little star, and then a big down day. But it didn't end up being much of a big down day. It was more of a sideways day. So I don't think you can call it that pattern. But again, with AppLovin, now that it's below the 200-day, now that it's failed to hold support, this is where I'm going to wait. I'm going to wait for signs of accumulation. That means improved momentum. That means improved relative strength. And it means regaining moving averages. For now, this is a stock that's in breakdown mode. Folks, that'll do it for today. Thanks so much for joining me here on Chart This with Dave Keller. Thanks, as always, for following me in my work. I hope stuff that we're sharing on the show is helpful to you. I appreciate the kind words and feedback that you've shared with me. I'm very thankful for the opportunity to talk charts and talk markets with you. If you have any questions that came up after watching the show today, please take a moment, drop it into the comments section of our YouTube channel. Maybe we'll feature it on this Friday's episode. For now, I'll say have a great evening. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.